It's Shauna the Tax Goddess and Chief Tax Strategist for TaxGoddess.com, StrategicTaxCoach.com, and DropMyTaxes.com. Super, super excited to be with you here today on part 2 of our little mini-series with the very handsome Sean Weiland. We are going to be covering part 2, tax strategy with asset protection, and today is on defined benefit plans. So thank you for joining us here on our channel, Tax Strategies That Save Entrepreneurs Thousands Each Year. We are here to educate, entertain, and or inspire, and of course, help you guys reduce your tax bill in all the legal ways possible. So thank you so much for being with us here today, Sean. We really, really appreciate having you. And for our guest listeners, if this is your first time here with us at Tax Strategies That Save Entrepreneurs Thousands Each Year, make sure you subscribe, click the little bell icon, show us some love during the watching of this, give us thumbs ups and shares and all that other good stuff. And remember, you can always download our free ebook, 10 Ways to Save 10K, right now from any of our websites, TaxGoddess.com, StrategicTaxCoach.com, or DropMyTaxes.com for those do-it-yourselfers out there. So, Sean, you ready to talk about part 2, defined benefit programs?
Absolutely.
Rock on. Tell us all about it. Why is this awesome for our listeners out there?
Okay, so anytime you're thinking or hearing about setting up a SEP, a simple, or a 401k, I want you to think about defined benefit. A 401k, even well-structured, really tops out as far as a deductible amount of income at around $55,000. That's for 2018. Every year it goes up slightly to keep up with inflation. But with a defined benefit plan, it can be calculated and structured in such a way that you could deduct up to around $200,000, $220,000 of your income.
200,000. Wait. We can pause there just a second. $200,000.
Right. So roughly about 4 times as much as people think of, and that's even more than the 19,000 most people think of as that matching deduction in a traditional 401k. You are able to max it out to about 55,000, but with this, yeah, it's closer to about 200,000.
Awesome. Okay, sorry, keep talking. This is too exciting. Go ahead.
So it will depend on working one-on-one with whoever your professional is to get that set up. It requires an actuary. It's a very bespoke system, and it's based on the idea of instead of a defined contribution like a 401k, it's calculated back from a defined benefit, so more like a traditional pension plan. But in order to fund that pension plan, you of course have to contribute towards the pension fund, which is what a defined benefit plan is. Depending on your age, number of employees, and so on, that's what's really going to determine how much that you can deduct. It's a plan that's very well suited for small groups of professionals, so doctors' offices, dentists, attorneys, because there are still rules as far as participation, just like with a 401k. If you have a lot of employees, a lot of employees who are not making as much as the owners, the calculation for that may not actually be in their benefit. But assuming a small group of highly compensated participants, it can be an excellent way to then deduct that $200,000 into a trust to fund that pension plan. When you go to retire, it doesn't have to become a pension. You can roll it out into a traditional IRA, just like you would a 401k or a 403b. But you are able to deduct that off of your business income from the top. And it's a significant amount, so worth considering.
Love it. So I want to repeat it back, make sure I understand like the perfect example, somebody that this would really like be a rock star for. So you said small group, maybe older, right? Is because I would assume.
Yeah, because it's calculated on age for a pension. Older allows you to put more away. Younger people, based on the IRS calculations that they use, it's not as much. But it could, even if you're a 30 or 40-year-old, well-to-do entrepreneur, it's still worth considering.
Okay, so if you had a small office, for example, husband and wife, they've been running the business for a long time. They're both maybe 60, 65, right? They have maybe 5 other employees who are in their 20s, right? They're just kind of more like assistants or whatever. That might be maybe a good option, but of course, run it past the professional, get the calculations done, do the census, right? I mean, because you just never know.
Right. It's going to You'd have to examine it on a case-by-case basis, but you'd have to get that information together and match it against the rules for participation and make sure that it's to be to their benefit. But if you have, a dental group of, 3 or 4 dentists that are all, making, say $600,000 a year, and they don't need all of that to live off of, they'd rather save a good chunk of it for their retirement. That's certainly an approach that they would not have to pay that income tax now. They could defer it just like you would in a 401k or an IRA, but at a much higher contribution limit than those more common plans allow for.
Well, more than 4 times. I mean, we were at 55, now we're at, you said 220. I mean, it's 4 times almost headed up to plus beyond that. So that's awesome. Okay. Well, yay. Okay. I'm too excited because that is huge. For a lot of people, the only thing they've ever heard of ever is a 401k. Maybe they've heard of like your IRA or your Roth IRA, but those limits are like 5,500, depending on your age, right? There's much, much, much smaller. So very, very cool. Okay, well, thank you so much, Sean, for being with us here today. This is excellent news for all of my little tax strategy people, my peeps out there. This is absolutely excellent news, and this is exactly why we bring you experts, okay? Because we want to bring you value in the form of education, entertainment, inspiration, right? This is definitely education, and of course, I'm super entertained because like $200,000. Totally in, okay? So I hope you guys are enjoying this as well. Sean is going to be bringing us part 3 of a mini-series on tax strategy with and for asset protection, premium financing of life insurance. So make sure that if this is your first time here with us on the channel, that you subscribe, you click the little bell icon, you show us lots of love. If you have any questions or comments or anything, put it down in the bottom down below. We want to make sure that you're working with a professional, so reach out to your professional, ask us questions. This is why we are here, is to help people. So in the meantime, remember to subscribe, give us some love. We have podcasts too. If you guys haven't checked those out, check us out on taxgoddesslive.com. And of course, you can join our Facebook group, Tax Strategies That Save Entrepreneurs Thousands. Thanks so much for being here with us today. Signing off with much tax love, your tax goddess and chief tax strategist, Shauna. Bye.